everyone. My name is Irvan Praditya. I'm a student from National Formosa University in Taiwan. And today I'm presenting a paper about a Wavelet-Copula analysis on the triangular transmission of crash risk, examining how volatility risk as volatility spills over a US and global commodities through East Asia and finally to Southeast Asia. And I will,
போட்டோ நீதான் எடுத்து
the,
போடணும்.
I'm sorry,
ரூமுக்கு நீதான் போட்டோ எடுத்து போடணும்.
uh, pardon, can you repeat?
Yes, you can continue your presentation.
Okay. So the let's directly start to the introduction and motivation. The global financial system has evolved into a really complex multi-asset network, but our traditional risk models have failed to keep it up. So the standard central periphery models, it's assume that risk flow directly from the US to emerging market like the Southeast Asia, but and it's and assuming it's like in linear transmission. Furthermore, the standard gauge models also ignores the leverage effect, and the Gaussian copulas assume that tail independence, an assumption that completely vanished during a market crisis. Because of this, we propose the triangle hypothesis. Volatility is amplified through East Asia industrial supply chain before it's ever reached to Southeast Asia. And to test this, we categorize to three function roles. First, the United States and the commodities, and the United States specifically in the tech sectors that generate systemic shocks. And in East Asia, including Japan, Korea, Taiwan, and China, is absorbed and amplifies this shock through supply chain disruption. And finally, in the Southeast Asia, in Southeast Asia, it's the receiver of the endpoint of the volatility. Sorry. And then the research question for our paper is the mainly three question. Is first, is it indirect, the triangular pathway stronger than direct from US to Asia or Southeast Asia? And then the emerging market, Asian markets are more vulnerable to joint crashes or joint booms. And finally, are the markets like China and Vietnam are structurally decoupling from the US? And for the literature review is comparison between a debate between linear and versus Copula contingent in simplified way. So focus now onto the data. Data is from a 25 years crossing from 25 years from 2000 and to 2024, covering 15 equity indexes from US, East Asia, and Southeast Asia, and also 3 commodities to test the dependencies across multiple major crises. So involved in the global financial crisis and also COVID-19 lockdown pandemic. Now for the methodology, it's because the traditional linear models ignores the market panics. So we built a 5-stage quantitative pipeline. First is a wavelet the decomposition, where it filters the long-term trend and isolate 2 to 4 days high frequency. And then the second is the gauge filters, or the GJR gauge, to simplify the reason to capture the leverage effect, because the bad news spikes market volatility significantly harder than the good news. The third is the EVT, or extreme value tail modeling, is because the financial crashes lives around these extreme fat tails of a distribution, which normal distribution usually miss. And the fourth is SJC Copula, is to measure the asymmetric dependence, allowing us to model crash risk entirely separate from the boom risk. And finally, the Bayesian's MCMC on the Monte Carlo chain to provide robust credibility intervals. Now, to the result for proving the standard model fails, you can see on the QQ plot on the right from one of the result of US consumer discretionary sector, or the ticker is XLY, that the dots are deviating far from the red line, which the red line represent the normal distribution, and the dots are the true event. And by using on the left side on the generalized Pareto distribution, the black curve on the left successfully captured these extreme fail events that standard Gaussian models completely ignores. So it's proof that the extreme events or live outside the red line. And then the second method, the GCR gauge, I use the example from the Vietnam index, is that you can see the reality of the volatility clustering here on the Vietnam index that standard model miss. And we can capture the asymmetric of those spikes because of the negative shocks generate this disproportional massive burst of volatility in the 2008 from global financial crisis and 2022, for example, for the COVID-19 lockdown. And then this is the heavy tail heat map. As we can see this out, that's the triangular pathway become highly visible. From the phase one is from the US to Southeast Asia, US to East Asia. And then the phase two from East Asia to Southeast Asia, and the third phase is US to Southeast Asia, is that on the phase three, it's not that strong compared to one and two. And then this is the more specific numbers, where in the phase one US as SOX or the semiconductor index act as a primary contagion factor to the East Asia, especially in Japanese and Korea. But the S&P to the to East Asia are more symmetric or more balanced. But to China, it starts to decouple. So that's the big difference. And the phase two, this risk is drastically amplified, where East Asia transmits extreme crash risk down to Southeast Asia, especially Indonesia and also Thailand. And then for the phase three, for US directly Southeast Asia, you can see the transmission from the US to the markets like Thailand and Vietnam are remarkably kind of low. And that's why the risk does not skip the supply chain. It flows directly through it and multiplies from the East Asia. And then for the commodity, looking at the exogenous shock, Brent acts a massive cost shock to Asian manufacturers, showing 4 times higher crash transmission uh, to the market compares to the WTI. Meanwhile, we also conduct for Bitcoin because it's start raising after 2008 crisis, risk measurable competitive crash risk, especially to the Asian like Taiwan and Japan, crucially upstream. Also, equity backs to negatively proving the commodity shocks the system, but not structurally by short term. And then the discussion that we really discovered is the Sino-centric risk for decoupling in China and Vietnam. And if you hear the prayer calling from my place, I'm really sorry. Uh, I cannot stop it. It's just it's just the time for that. So the decoupling is that the structure found this the rise of the sinometric risk cluster, where the Shanghai or China show negligible tail dependence to all US index. It is entirely decoupled from the US liquidity cycles. And not only that, but the frontier market like the Vietnam, the emerging market, showing that's the sign of pivoting away from the US also and towards to the China. So the conclusion is that the implication of Southeast Asian regulatory is clear, that risk follow the supply chains. Traditional way cannot warning system that are not, you not only monitor the US fund rates, but also you need to track the upstream supply chain indicators like US stocks of semiconductors and also Taiwan Stock Exchange. And then the decoupling of the China and Vietnam from the US and Japan, Taiwan is also a freeze framework that needs to be noticed. So that's thank you for for your time for listening to my presentation. I'm really sorry for the interruption at the end of the presentation, and I welcome any question or recommendation for the research. Thank you.